Hey everyone, well, we're going to get started with today's masterclass on how to get started as a passive investor. And today we're talking about one of my very favorite topics, which is risks. Because with every investment, there are risks, and you still have to make forward progress. And so the key to being able to confidently invest is to understanding the risks and making sure that you know how those risks are mitigated. And when I first got into this space, so this is masterclass on real estate syndications and how to become a passive real estate investor rather than a landlord where you own, say a single family house or a duplex. We're talking about real estate syndications where you can own a piece of an apartment building or another commercial real estate asset. And so we're going to get into the risks. So just a really quick, brief overview. I'm Suja. I'm the founder of Lux Capital Investment Group. And today we're going to welcome Sarah. And today we're going to talk about risks. So here's just a photo of me. This is why I do real estate investing, so that I can go on big trips and have freedom of time over my schedule. That's a huge reason. This year I'm going to Peru and for 3 weeks, and I can, when my sister got married, I could easily go and spend like a week with her and my family preparing for that. And I can go and spend a week taking care of my nephew if I want. And, that's really, I didn't have that freedom when I worked in corporate America, and I had limited vacation days. And yeah, I just wasn't happy with that. So that's one reason why I found my way to real estate investing. And I've done many things in real estate investing from, I started flipping a house with a friend using my student loans. So I'm one of those people that started with no money, and it is possible. And, I've talked to many people on my podcast about how they do real estate with no money. And yeah, so that is a limiting belief that if it's one of your limiting beliefs, you should check out my podcast and learn how to get started with no money, because it is possible. That being said, it's also helpful to have money. And that's what we do here is we put your money to work so that you're taking advantage of the time value of money and hedging against inflation. And that's why I'm really passionate about real estate syndications, because one of the things I did in real estate was I developed an Airbnb business, and I had great cash flow, like just a ton of cash flow. But with a ton of cash flow comes, one, you have to pay taxes on that. And two, it's still a job. If I wanted to grow my, real estate portfolio, then I would have to basically be adding responsibilities onto my plate. And I wanted to develop purely passive streams of income. And so that's how and I also want to diversify outside of hospitality. So that is why I got into syndications, diversification and passive streams of income, plus, of course, like retirement savings. So what I do now is I take the cash flow from my business and I put it into short-term rental, I put that short-term rental revenue and I put it into real estate syndications. And I think the same philosophy or approach can be applied to anybody who has extra cash that they do not use for their living. So like if you're able to save, that's great, but how do you invest that effectively? And so that's what we're here to talk about, is real estate syndications. It's my personal favorite way of investing. And that is one, because I understand it really well. And so since starting Lux Capital a couple of years ago, we have just grown tremendously. We have invested in over 37 self-storage units, as we now have 2 multifamily properties, or 3. And we've got 250 verified investors, over 40% repeat investors. And here's just some quick photos from the last year of site visits, starting my podcast, etc. And for those of you who haven't been to one of these yet, this is your first one. Here is a list of all of the previous master classes, which you can go and check out on my YouTube channel. And you will be I will be sending out a replay, which also will have links to all of these. And so you can go back, listen to them while you're in the car, and give yourself some of that foundational understanding of how this all works. Going forward, we will probably start covering some more advanced topics. I'm excited to do a underwriting series where we're actually going to underwrite a whole deal. And, that's going to take several weeks. So we're going to keep progressing. And so if you're new, then please feel free to check out the previous webinars. Okay, so for today, we're going to talk about the risks. As I said early on, risk is a part of any investment, whether it's stock market, whether it's crypto, whether it's gold, whether it's a single family house, etc. There's also lots of different ways to invest in real estate. You could be a note investor, for example. You can invest in shopping malls, or you could invest in, of course, we don't do that, but you can invest in shopping malls. You can invest in multifamily, single family homes. And for every single one of those types of investments, there are going to be different risks. And, I don't mean to convey that we can cover all of that in one webinar, because really understanding risks is the heart of investing. And so we're going to go over some things, and just know that there's many, many more layers that can be covered. But, we want to sort of be able to wrap our arms around it and feel like we have a basic understanding. And that's what we're going to do today. Okay, so let's say you want to invest into a syndication. You're going to put in $25,000 or $50,000. Maybe you will wire that over, and then hopefully when you do that, you want to know, well, what are the risks that I'm getting myself into? Okay, and so the number one risk to an investor is a capital call. And a capital call happens, it's kind of a worst case scenario in my book. And it happens if the operator needs to inject more capital into the property due to unforeseen circumstances. So for instance, say somebody bought a property, and then, I was just talking to a podcast guest the other day, and he found that somehow in the inspection process, they missed that the parking lot, which was a concrete parking lot rather than an asphalt parking lot, had some like crazy thing in the middle. And like basically the parking lot was just like, it was just basically destroyed and needed to be completely redone. And it was concrete, so it was kind of expensive process. And so those things can happen, and there's lots of different ways to handle them, which, we can get to. But in general, I mean, and so I don't want to just right now, we're just going to go over the risks, and then we're going to go over how we handle those risks. So a capital call is basically when, if I was to say, hey, you guys, I know you already put your $50,000 in, we actually need you to put in another $10,000 in order to make sure, in order to handle this particular aspect, or in order to service our mortgage payments. And so, like I said, this is like a worst case scenario, and any really good operator is going to make sure that that never happens. And there's ways that they can make sure that that never happens. For example, if they have connections, they can always take a supplementary loan to the project. So if, either they can make a loan themselves to the project to handle those expenses. And also, how did they get in that situation in the first place? So they did not potentially have enough reserves, or the deal wasn't structured properly. So yeah, we're going to get to that, but just so you know, that is something that is usually a possibility. And the way to prevent against that is to make sure that the operator is, one, being smart about what they're doing, two, is reserving enough, and three, has enough financial wherewithal that they could potentially fund that capital call rather than ask their investors to do that. Okay, number two is distributions. So we always put out projections of what we plan, an operator will always put out projections of what they plan to distribute. And sometimes those projections are not met for one reason or another. That is a risk, that the distributions either need to stop, or they're lower than they were. And That happened with some operators during COVID. For example, some operators suspended distributions, some lowered their distributions, and some did not. But that was a risk with these types of investments, which are equity investments. You're not getting a guaranteed payment, you're getting cash flow. And if the property isn't cash flowing, then your distributions might not flow. And again, there's lots of ways to mitigate against that. And that's why, we're going to talk all about that. Obviously, under promising, over delivering is one of them. But there are other things we're going to go over. So, and then I would say number 3 is kind of like how you would, what it is that you need to evaluate actually. So number 3 is the business plan doesn't go according to plan, and the operator needs to adjust. And this is actually a fairly, it's a fairly normal thing to have to adjust. I mean, that's why it's attractive to invest in real estate, because it's a venture. And sometimes, adjustments do need to be made. Like when COVID happened, it's like, okay, well, we pause renovations because people are wanting to save their cash. So we pause renovations and just rent out classic units and wait until the economy recovers, until we can actually resume renovations. So the business plan may need to change, but usually there's a plan A, a plan B, a plan C. And ideally, a good operator is going to have several exit strategies and actually already know what they're going to do in any given circumstance. That being said, things always come out, and the ability to just figure it out, and having set yourself up to not be overexposed is going to really help with any sort of improvising that needs to happen. Okay, so let's get into, so I would say that capital calls and, and a risk to the distributions are the biggest risks. As private passive investors, you do not have liability. So like if somebody were to slip and fall on the property and sue the property, then passive investors are not going to be liable for that. And it's the operators that are taking on that liability. Of course, they have insurance and whatnot. But liability is actually, thankfully, not one of the big risks of syndications. And that's why it's not on here. Okay, so let's talk about, basically this slide is about risks to the business plan. So why, we're always looking at what is the operator's plan? What is the operator's business plan? And do I think that their plan makes sense? Do I think that there's enough contingencies in place so that if something doesn't go according to plan, that there's still enough padding in the deal to make sure that we have a successful project and we're able to meet our distributions, and most importantly, that we do not lose capital. Capital preservation is huge, and it's one of the most important reasons why we invest in real estate. And that's, so we want to evaluate the business plan to make sure that there's no capital calls, and so that the projections are being met and exceeded, hopefully, and so that we don't lose capital. Okay, so what are some risks? Operator expansion. This one's pretty straightforward. A lot of operators, when they grow really quickly, they need to also grow their systems and their teams in order to be able to keep pace with their growth. And it's true, we invest with some high growth operators, and we have evaluated their ability to grow their team. So for example, one of the operators that we work with is a self-storage operator. They're on the Inc. 500 list, which means that they're one of the fastest growing companies, fastest 500 growing companies in the USA for like the second year in a row. I think they were 135 last year. And they're growing their team. And one of the ways that I evaluate that is I've spoken to many people on their team, and I know that their company culture is really amazing. I know about their weekly meetings, and I've talked to people who work there and talked to people who are really happy there. And so they're creating a culture, a work culture that's sustainable and where people are drawn to. And that's critical for making sure that an operator is going to continue to grow. Another one of our operators that we work with, we're just talking to them about how they're growing so quickly. And they're talking about how they've hired a bunch of people who they don't even have work for yet, or, a full 40 hours of work, because they're priming their team because they know that they're going to be adding X number of properties this year to that's their goals. And so they're prepping their staff, getting everyone trained up and ready to hit the ground running, so that they can deliver on those business plans. And so a lot of this is about getting time on your side and creating a situation that's not stressful. So being ready and poised to be able to respond to any type of situation. And so that's how we mitigate the risk to the business plan. Okay, so that's operator expansion. Let's talk about demographic trends. So another risk to, anyway, I guess I kind of talked about the risks and how to mitigate it. So you want to make sure that your operator is not expanding too quickly without a plan in place. Okay, number 2, demographic trends. So is the subject property in a growing market, in a stagnant market, or in a shrinking market? There are actually markets in the country where population and job growth are declining. And those are the 2 of the key metrics to look at, population growth and job growth. And so if the demographic trends are not in your favor, that does pose a risk. Although I'm not going to say it's a universal risk, because there are ways to have success in those markets. But when you invest in an area with declining population and declining job growth, or even just stable, that is a risk that needs to be mitigated in other ways. On the flip side, if you're investing in a market with a growing population and growing job growth, that adds padding to the deal. Okay, so in an example where you're investing in a area where the project is in an area, and I talked to many people who are located in certain parts of the Midwest, they're not your hot markets necessarily, although some are. So one way to mitigate against a declining population, declining job growth, is to offer a kind of product that is not currently being offered in the market. So for example, even if the population is like on the decline a little bit, there's still going to be people there who want to rent good housing. And if there's no good housing to be there's a shortage of good housing, and you can provide that to the market. If there's a shortage in that supply, that's a way to mitigate. And that's actually a fantastic opportunity. So I definitely don't want to give anybody the impression that like you have to do all of these things, because also no perfect deal exists. There's usually going to be something there is going to be some risk that's not ideal that is going to need to be mitigated in some way. Okay, number 3, supply and demand for housing. So we kind of touched on this before, but like, what is the current housing supply like in the market that you're going for? Is there a shortage of housing? Is there a surplus? There's not as many markets with surplus of housing as there were in 2008. We were overbuilt in this country, although every market is different, and it's really important to understand the specific overall market as well as the sub-market area. And if there is a lot of new product coming on the line at a affordable price, that could pose a risk to your project, right? Like, what is the competition? Is the competition posing a risk to the project? And part of mitigating that is really understanding exactly who it is that your tenant base is serving. So for example, with one of our projects, we're investing in multifamily in the Phoenix area. And in that project, we asked the operator, well, what about new construction that's going up in Phoenix? And, new construction like build to rent, which is kind of townhomes that are for rent. And they're very clear, our operator's very clear, that the tenant base that we are serving with our project is a different tenant base than the people who are renting build to rent properties, right? Because people who are renting those townhomes, that's usually their last stop before buying a house. Whereas people who are coming to our homes, it's not their last stop. Like they're renting, it's workforce housing. We make the properties nice, but it's still not like, it's still one notch below a townhome for rent. And so understanding that it helps us gives comfort that, that those particular townhomes don't pose a threat to us because they're serving a different market. And because, of other factors like population growth and job growth. So that's supply and demand for housing, which kind of leads into number 4, which is competition. But first, with competition, I want to talk about A, which is the risk, or which is what you purchase the property for. So we talk about basis, which is like price per unit. So did this property get purchased at $250,000 a door, or did it get purchased at $100,000 a door? And, you can't say that one is good or the other because it's very dependent on the market and what's happening in the market. But you do want to understand, okay, so if I'm purchasing these, this 232 unit apartment complex at $200,000 a door, then you want to compare that. You want to compare that to single family homes. So what are single family homes going for? The average single family home price, the median is that, $350,000 or $450,000. If it might not be unreasonable to buy a apartment building at $250,000 a door if single family home median price is $450,000. And then you also want to compare that to like condos in the middle, in the inner city, or nearby. Like, what are condos going for? And what are the rents of those townhomes or condos? If the condos are being rented. And so you want to look at basis. There's not a one size fits all answer, but making sure that you understand what you're buying the property at. And then of course you've got to add in, does the roof need to be replaced? Like those major upgrades that are going to happen, the major capital expenditures, you have to add that into your basis as well. So what are you acquiring it at? And then once you do the renovations, what is the basis or cost per unit? So that's a risk, right? If you're buying your property at a basis that's not actually, commensurate with where it should be in order to create padding in the deal, that's a risk. And I'm not saying that, you should never do that, but it is definitely something to consider and needs to be mitigated. And then rental competition. So another risk is that, one of the risks in my mind is that if you're top dog on the market, don't want to be top dog because ideally, meaning don't want to be the most expensive rent in the market, because as soon as things change, that people might move out of your place and into more affordable places, like if the economy dips. Now, that's not to say that there isn't there is never a place for being in that position where you are top dog, but if you are, then you really need to, that risk really needs to be mitigated, and you need to have a clear idea of what the different exit strategies are. And it's not usually where we like to be, but I'm not saying that it could never work. Also, you're always balancing risk versus reward. One of the reasons I like real estate syndications is because I believe that the rewards that we get are very, very, very attractive relative to the risks that we're taking. But even within real estate syndications, there's varying levels of risk and reward. And so understanding where your risk tolerance is and trying to find that perfect match for you is important. Number 6, basis cost per door. We already covered that. Number 7, another risk, which I suppose could have gone on the previous slide, is illiquidity. So with real estate syndications, they're not liquid. You don't get to decide when we sell the property. Of course, we want to do as best as we can for our investors, and we want to, refinance as quickly as possible. We want to, different operators have different ideas about whether they want to hold the property long-term or whether they want to exit. But point is that it's not up to the investors to decide, and there's not a way to sell the shares that you have in an apartment building on the open market. One caveat to that, and you might have heard me mention this before, is that may be changing. In fact, it probably will be changing with something called tokenization. And it's not something that I'm really putting a lot of effort into understanding right now, but I do know that it's coming and will change things up. So you probably will be able to sell your shares in an open market with some deals at some point in the near future. And okay, another risk, this is from my, for example, what liabilities does a project have? Environmental is a big one. This is and so it's really important to make sure you and your operator, or your operator, but that you understand that your operator has looked at all the environmental risks. If there's some issue with the environmental studies, usually we have to do a phase 1 and maybe we have to do a phase 2. If those aren't addressed, then they can cause major liabilities for the property and major headaches. And so you just want to make sure that your operator's really taking care of that, but it is a risk that has to be you have to be made aware of and mitigated. I mentioned the concrete, for example, there are always possible repairs that will need to be made that we weren't aware of. I mean, it's just possible to miss things. Like, you can evaluate a property and you can go through all the things, and something might still get missed. No matter how many people you have looking over your shoulder, it's still possible. And so how do you mitigate against that risk? Well, having really strong reserves at the property. What does that mean? Reserves are called like working capital, capital reserves. There's a few different names for them. Essentially, it's like what reserves are kept at the property so that we don't have to do a capital call, so that we can cover unexpected expenses. And of course, there's always a little bit of a double-edged sword with that, because if we have that money at the property, then we're also paying interest on it. And we're paying, that's a cost to the project as well. So, you want more than enough reserves to be comfortable. Project still has to pencil. But it is like one way to mitigate the risk of a liability is having substantial reserves. And I'm definitely in favor of making sure that the property is well reserved. Okay, number 9, interest rates. So interest rate risk, that has to do with, there's a couple different ways that can affect us. We know that now it's currently February of 2022. And we know that the Fed is probably going to raise rates, at least they've indicated as such, in 2022. So what does that mean for us? Well, number 1, do we have a fixed rate loan or do we have an adjustable rate loan? And so a lot of times, the whole topic of loans, we need a whole session on that. But ideally, you want to make sure that, there's not necessarily one ideal, but there's different things that can affect the attractiveness of a loan and how much it's helping versus producing risk to the property. So with interest rates specifically, we want a fixed rate. We want to also know if that rate's going to change. So for example, agency debt is a fixed rate debt. However, usually there's a drawback to that. So with agency debt, one of the drawbacks is that there's a prepayment penalty. So while you don't have interest rate risk, you do have a prepayment risk. And so that's a risk that needs to be balanced. Sometimes there's bridge loans, which have a fixed rate for 3 years. And then you have like a cap on the interest rate that's going to be for year 4, and then another cap on year 5. So you can have extensions. And so there's some interest rate risk there, but then there's virtually no or almost no prepayment penalty risk. And so, with the case of the bridge loan, we're in a rising interest rate environment now, potentially. And so the interest rate may increase, but we don't have a prepayment penalty risk. And so you got to really understand the operator's business plan, and if you think it's achievable in a certain time frame, and understand their goals. And it's not necessary. When I first got into the business, I used to want to know, like, well, what does it need to be? Like, what does this need to be, and what does that need to be, and what does this need to be? And the thing is that, like, you have to look at the whole picture and look at it in context, because there's almost, especially in this environment, there's almost no completely cookie cutter deals, because there are so many people who are interested in this space. And so it's not as boring as it used to be. You have to be more creative. Okay, so another thing about loans is that, if you've been following me for a while, you know that, in my opinion, loans are the biggest source of risk to any real estate syndication investment. And why is that? That's because usually, we know that we can make a lot of money in real estate, but we also know that people have lost their shirts in real estate. So why have people lost their shirts in real estate? You can almost always trace it back to the debt. What kind of debt is on the property? Is the property over leveraged? Is it leveraged at 65%, 75%, 85%? I've even seen 95%, 99%. If a property is leveraged at like 95, 99%, that, which I know it sounds crazy, or it might sound crazy to you, but I've seen it happen, then there's no room for error, and there's no room for, anything to go wrong. And if something, anyway, so we want to make sure that the property is not over leveraged. We want to make sure that we understand the terms of the loan fully. Interest rate, is it an interest only? Is it, like, for example, if it's interest only, that takes a little bit of pressure off of us because we don't have to make those principal payments as well. And so it just means that if there is a shift in revenue, then, we are not having to pay that principal. We're just paying the interest. And so it makes it so that there's much more padding in the deal. Of course, if we're doing an interest only loan, it also means that we're not paying our principal down. And that is, that's not a huge risk, but it's a consideration. So you want to look at it holistically. And the last one that I'll talk about on this slide is loss of managers. So you want to make sure that your operator has a succession plan in place. So what's going to happen if there's an untimely death, if somebody, it's something like that. And so you want to make sure that that is in place. And, for me here at Lux Capital, that's actually something that we're currently implementing, because I am kind of a one-woman shop. And while I often have partners, there's a couple deals where I don't have partners. And so in that case, I need to have someone who can run the business if something were to happen to me. So having a succession plan is really important. Okay, so we just talked about kind of some risks and how to mitigate, and I want to go over some other major reasons why syndications are particularly well positioned on the risk versus rewards graph. Okay, so number one is cash flow, and this might look familiar to you because this is also the 5 ways that your money makes money for you, which is another webinar that I did. But let's just talk about that relative to risks. So cash flow, investing in a cash flowing deal, that means that if the market does take a downturn, then we're not going to be forced to sell the property when the market's down. We can hold the property, it's cash flowing, so we can pay the mortgage and all the expenses and pay out distributions to our investors potentially, and just hold that property until the market gets to a certain point. Like we know that markets do go in cycles, and there's ups and there's downs, and no one has a crystal ball. But overall, real estate prices have continued to go up in the long run. So cash flow, if you can buy a cash flowing asset, that really mitigates risk of losing principal. You might have to extend the timeline, but it is, so for example, if we were to buy into a development property, which I'm not opposed to development entirely. However, if you are investing in a development deal, then it's not cash flowing, and also there's construction risk. And so that adds another risk that should be compensated for in some way. Oftentimes with development deals, the returns are higher, and that's because it's at a different place on the overall risk versus return graph. And so it might be appropriate for some people depending on where you are. And there's also, you can also look at development as the ultimate value add. And so, in places where there is a tremendous shortage of housing, there's still going to be a demand for new housing. And so, like, especially landlocked places that are very popular to live, but don't have a lot of land left. So development is not, I'm not trying to say that it's categorically well, that it's not a good investment. But because it's not cash flowing, it does pose a risk that has to be accounted for in some way. Okay, and also I don't know if I mentioned this, but please make sure you put in the chat if you have any questions, and I'll try to answer them as we go. Okay, so number two, we spent a long time talking about leverage and how to mitigate it. So basically, you want to make sure that your loan matches your risk tolerance, or not yours, but the sponsors. That the sponsor's loan is aligned with their business plan. And usually, an experienced sponsor is going to, have a good relationship with a lender and have evaluated a lot of different types of lending opportunities. And but if it's a newer operator, you want to make sure that they really understand what they're doing and that you understand what they're doing with their loan. So that's number two. Number three, equity growth. So there are, one of the great things about real estate is that we're not just relying on one way to make money. We're able to make money in different ways. So for example, when we talk about the three levers, it's like, well, one, we can bring the rents up to market. Oftentimes we're buying properties that do not have market rate rents. It's a very common way to increase the value of a property. And number two, we can decrease expenses. That is, can't always necessarily count on decreasing expenses, but it is possible through greening the property, potentially through evaluating staff. Like if we have a vertically operated firm, so if our operator has a property management company, then they're going to probably be saving some money on property management on the P&L of the property. And then number three, we add additional streams of income. So those are three different ways. Like, we're not just relying on like one thing. We have three different opportunities for actually growing the equity and the cash flow in the property, which is just another way to mitigate. Again, when you think about mitigating, it's like, how can I add more padding to this deal, right? Because things do go wrong or not according to plan. And so you want as much padding as possible. And number four, tax benefits. That's another way to add padding to the deal, because your returns are protected from, your operating returns are protected via depreciation and cost segregation. This is in a section on tax, and then your gains can be protected either by reinvesting in a syndication or by investing in an opportunity zone or potentially doing a 1031. There's a lot of complications to that, but it is another way to add more of that padding to the deal. And number five, appreciation. Investing in a strong market where population growth is really high is another way to sort of make sure, it's icing on the cake, but it is another way to add padding to the deal. If you're investing in a smaller market, then it might be easier to get a deal, which is important. But you're not necessarily going to be mitigating on the appreciation side because it's going to be a slower growth market. Again, there's costs and benefits, right? Like in a very hot market, like Phoenix, for example, it's going to be harder to get deals, right? So you have to have a way to get deals. How do you get deals? You've got to align yourself with the right partners, or if you're working with an operator who has a lot of broker relationships, who's doing a lot of business in Phoenix, they can get those deals before they even hit the market. So that's one way to mitigate against, because that's way to, however, if you're in like a smaller growth market, there might be less competition and, you still probably have to work it to get good deals, but maybe it's just a different market. And so you have to use different techniques. So appreciation is like one way to mitigate, and you just have to know. You don't want to ever rely on it. We never want to rely on appreciation, but you do want to know, like, well, is it more likely in this market to appreciate, or is it more likely in this market to stay, kind of bumping along like this? Okay, so considerations. Okay, so this is kind of a review and some other things that we just haven't maybe covered yet. So as we said, adding padding to the deal, evaluate the reserves of the property. And again, there's a certain skill that's involved in that, but we're just talking about in general terms right now. Invest in growth markets where demand is high. So that's with the caveat of making sure you're getting the property at a good basis, because obviously there's this idea of overpaying, and some people believe that people are overpaying for assets. And of course, you never are overpaying necessarily. If the market continues to go up, you might not be overpaying, because if you can sell before the market drops. But in any case, the point is that you have to kind of know where you're at, and how make a calculated decision about whether it makes sense to pay a certain amount. And so when you invest in growth markets where demand is high, that just inherently adds some padding to the deal, as long as you're buying right. Number 3, look for minimal competition. We talked about this. Don't want to be top dog. But in a vibrant market, there is going to be some competition, and that can be, a good sign. But you want to make sure you know exactly who you're serving, and that there is a lot of demand for that product that you're providing to your ideal client. Look for written rent premiums below the market. So that's another way to mitigate, is to, when we're looking at pro forma rents, making sure that they're still below market, because if we want to make sure that we're not being overly aggressive in our business plan. And that again adds padding to the deal, because we might be able to push rents to market, but if we project that, then we're kind of saying, well, we have to get to the market rent. But what if market rents go down? Another way for investors to mitigate is to vary their investment timelines, because one deal might sell in 3 years, another might sell in 5 years. And if you're having deals exit at different times, it can kind of even out your cash flow. Again, you can't necessarily control this, but if you sort of keep that in the back of your mind, like that you want to have some variation in when deals are going to exit, then that can kind of also, it just spreads out your risk as well. Because they're like, what if what if someone was investing and they invested all their money in 2015, and in 2020 they were planning on like getting all of it back? Well, their plans would have been delayed, right? Because of COVID. Most people didn't sell during COVID, although some people did. Okay, another important way to mitigate, make sure that your operator has lots of different plans for exit. So it shouldn't just be one plan. We want to make sure that there's options on the table. And you should ask the operator, what are the different options for exiting? Because there's all these different things that can happen. Refinances can happen. Selling the property, selling part of the property if it's like a portfolio of properties, or holding on to the property for cash flow. There's doing a different type of changing the debt, right? So maybe they started with a bridge loan, but then they want to switch to agency debt. Environmental studies. It's important to, as you become a savvier investor, start to understand insurance and environmental. Not saying you have to do that now, but it's just something to keep on your radar as you become a savvier investor, becoming comfortable reading those documents and knowing what could go wrong there. And then lastly, investing with an operator with a track record, that always gives me comfort. I mean, not to say that you can't build a track record. You can build a track record. But when you have, as a passive investor, I would say that it mitigates your risk if you're investing with an operator who has a track record, because typically you learn a lot when you develop a track record. And so those mistakes are less likely to come up if you have a track record. So in conclusion, I think I would just like to, remind us that we're really trying to evaluate the business plan and look at it holistically. So looking at the expenses, the rent, the basis that the property was purchased, and what the plan is, who's the target market, and can that sponsor deliver on this plan in this market? And if not, what are the contingency plans? So I think that kind of sums it up as far as the risks. And I know we can go a lot deeper into it, but I'd like to pause there. And thank you very much. And now feel free to ask questions, you guys.